Welcome to the Living Your Greatness podcast. I am your host, Ben Mummy. The purpose of the podcast is to inspire millions of people across the world to achieve greatness and enhance their overall personal well-being. Living Your Greatness is becoming the go-to resource that CEOs, elite athletes, professional coaches, and entrepreneurs rely on to upgrade themselves. The podcast helps you master the best of what other people have already figured out. So I gladly invite you to sit back, relax, and enjoy tuning in to today's episode. Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and today we have a new guest to the show, and his name is Michael Oliver. So for those of you that don't know Michael, he entered the financial services industry in 1975 on the future side, joining E.F. Hutton's International Commodity Division, headquartered in New York City's Battery Park. He studied under David Johnston, chairman of the COMEX. In the 1980s, Michael began to develop his momentum-based method of technical analysis. In 1987, Mike technically anticipated and caught the crash. It was then that he decided to develop his structural momentum tools into a full analyst methodology. So Michael, I want to welcome you to the show. Pleasure to have you with us today.
Thanks, Ben.
Awesome, Mike. So let's kind of get kicking here. Tell us a little bit about yourself. Where did you spend your formative years growing up? And what inspired you to become an author as well as financial researcher and momentum structural analyst?
Well, let's see. I lived everywhere as a kid because I was an Army brat for a while. Like I was born in an Army base. But as far as my career, I was going to be a political philosophy professor. And I was working on a PhD at University of Hawaii. This has been mid-1970s, 1973, 74. And I got all through my coursework. Now, if you recall then, you don't recall, but I mean, there was a global recession at that point. They called it stagflation. And commodities began a major up move starting from the mid-70s. But even in 73, 74, the world was into recession. And so professors, even professors who had standing at a university, didn't necessarily have a secure job. And I was particularly in a minority because I was a libertarian. Okay, now the libertarian movement, as we now know it, basically was born in the early 1970s. And I ran a nationwide newspaper called The New Banner, which dealt with the emergence of that movement and the ideas behind it. And in my mind, they were a combination of both Ayn Rand's philosophy, the author of Atlas Shrugged, Fountainhead, and the economics of Dr. Murray Rothbard. Now, I knew Rothbard personally, interviewed him for the paper one time, this was 1971, and now he passed on in the 1990s, but he's viewed now as the father of the modern libertarian movement. I wrote that book, Anarchism, New Libertarianism, Anarcho-Capitalism, as a master's thesis back in the early 70s. I was 50 years ago, okay? And I'm sort of surprised when I read it myself. It was pretty good, better than I could do now. And what I did is I married the philosophy of Ayn Rand, the basic concepts, not her politics. Her politics were limited government. And I married those with Murray Rothbard's free market economics, which is totally free market, meaning we don't need the state. Okay. Anyway, that's one side. But since I wasn't going to lead that career in political philosophy, I quit University of Hawaii. I was having trouble getting approval for the concept of my dissertation. And I could tell it was a recession out there as far as a career in that business anyway. And a friend of mine joined Merrill Lynch at the time, back in New York, as a commodity broker. And he said, come on in, the water's fine. Gold had been legalized in January 1975. In fact, it was libertarians who caused it to be legalized, a group called the National Committee to Legalize Gold out of New Orleans. And they managed to get it through. It took them a couple of years, but in 1975, it became legal, traded on the COMEX. We used to trade only copper and silver there. Now they traded gold. Well, I got hired by E.F. Hutton, which was at that time the second biggest commodity firm. Its department was second biggest in the world in terms of commodity volume and so forth. And it happens that the chairman of that department at Hutton in New York was also chairman of the COMEX during those key years. And so I didn't know anything about technical analysis, charting, so forth. He taught me the rudimentaries of price chart analysis, the orthodox stuff you were talking about, where you draw lines and so forth on price charts. And, sounded pretty good. However, over the years, next 10 years or so as a futures broker, I began to adapt price analysis and shift it to momentum analysis. Now, let me explain that. If you punch on your quote screen, anybody's got a quote screen and market stuff, they can punch little momentum tools, they're called, called MACD and RSI. Those are wet noodle type indicators. In fact, that's what they look like on your screen, little wet noodles, okay? They go up, they go down. We developed a more precise method of analyzing momentum, in which case we measured the action bar by bar, price bar by price bar, in relationship to certain moving averages, long-term moving averages, short-term, and plotted as an oscillator, not as a price chart. And lo and behold, over time, I learned, it was a one-man shop then, that momentum almost always would break its trend and go the other way before price told you it was going to go the other way. And so we had early warnings. And so in 1987, if you saw the momentum charts that I was plotting of the S&P 500, you would have said, oh my gosh, this thing's going to fall apart. But when you look at the price chart, it didn't look particularly bad all the way up to the last 2 bloody weeks, when it collapsed. So at that point, I decided to develop research and cease being a broker. And our clients up from that point, 1992 on, I started at 5 years after the crash, into 2015 were only institutional clients, mutual funds, hedge funds, banks, and so forth. In fact, it was a major bank that asked me to start my research back then. So only institutional clients serving their needs. But in 2015, we opened up to the general public, and it's fairly high priced. It's $1,800 a year, so it's not a real cheap research letter. But our focus remains the same. We analyze all the major asset categories, stocks, bonds, foreign exchange, commodities, especially gold and silver. So we analyze everything in an ongoing basis. And we try to call major tops and major bottoms, and sometimes things in between as well. And so we've done that now we're now past 30 years. We have at this point in time, and this is not a marketing statement, by the way, this is a true statement. The bull market that just peaked in stocks is the biggest stock market bubble in the United States history. Now, what do I mean by that? Well, it started in the low in 2009 and went through 2021, to a dozen years, from low to high. For the S&P 500, that was 7-fold increase in price from the low to the high. For the NASDAQ 100, which is the leadership index, meaning it has the big name tech stocks that led the bull market on a percentage basis, like Amazon, Apple, Microsoft, so forth. Heavily weighted stocks. They're also heavily weighted in the S&P as well as components. In January of this year, last year, 2022, 2 months after the high, we turned major bearish, long-term major bearish on the NASDAQ 100. And in February, we turned long-term major bearish on the S&P 500. So at that point, it was full thumbs down. Now, when we turned bearish, it wasn't just for a normal bear market, because we knew that never before had we seen a bubble this big. .com didn't compare. The 1929 bull didn't compare. In other words, if you measure from the bear market low in stocks to all these bull market peaks that later created bear markets, they were like doubles and triples. Some of them may be close to quadruples. Nothing approached 7-fold like the S&P. Nothing approached 16-fold. And when you go to the Federal Reserve site in St. Louis and punch up some of their metrics that are free, like money supply, or the Fed funds rate, which everybody's focused on right now, they drove rates to effectively zero and kept them there for 5-6 years. It was the lowest rate structure in the history of U.S. market. Money was free, helicopter money. And it wasn't just a policy to get us out of the hole in 2009. It kept going all throughout that dozen years. And therefore, when that river flow of money moved into markets, investors made the choice, starting in 2009, we did turn bullish in March of 2009, move that river flow into the stock market, which at that point in time made a lot of sense because the stock market had been beaten to hell. It was down to, went from 1,570 S&P down to 667. And so therefore, it was oversold and was due for an upside, but not a dozen years at 7-fold. But that monetary policy created that river flow, and large investors and small investors dumped that money into the stock market. However, when you got into 2021, doubt began to spring up among some large investors. And I don't mean based on our momentum methods. I'm talking about just in terms of their normal metrics, like, PE ratios or whatever you want to talk about. They got a little concerned that the risk reward was getting imbalanced. It wasn't really an optimal place to be anymore, the stock market. Maybe some other place would be better. So they started shifting some money out and expressing their doubts. Ray Dalio is a major hedge fund manager, for example, has expressed 6-9 months ago great concern. He says, quit looking at the price of your stock, look instead at the underlying decaying value of your money. So he was fully aware of monetary inflation as a factor. Well, once this process began, the market topped, and by our metrics, momentum structural methods, we determined that it was not just a top, it was the top of the bubble. And when bubbles break, they don't unwind peacefully. Even the 2008, 2009 bear, which had only experienced a move from about a doubling from the 2002 bear market low to the 2007 bull market high for the S&P, only a doubling. And yet it crashed all the way down and wiped out the 2002 low before it was over with. Full wipeout of the prior bull market. But it was only a doubling. And yet there was a lot of real pain, not just the people that own stocks, but people in the streets, so to speak. Average families, savings were gone. People were hurting physically and emotionally. This one's going to be far worse because of the nature of the bubble that's broken, the heights it reached, the prolonged period of time that it existed. And some of these analysts recognize this fact. And I don't just mean the stock market managers, but Nouriel Roubini, who's hardly a hard free market economist, he says this is disastrous. This is going to be worse than they imagine. The Fed has done something here that is going to be unbelievable. And he even mentioned social disorder, something we suggest is the next variable. And there's other economists out there too of major quality who said this is not going to end well at all. Not just a recession, it may be far worse than that. So that's what we're in for. And we think we've only just begun. And bear markets in the stock market, if you go back historically and look, they're arm wrestling matches. Whereas they don't go crash, boom, it's all over. 29 was the only time we started with the crash. And then it turned around and had a 50% rally back to its high in 1930, and then proceeded in an arm wrestling manner to go down through 1932 and fully wipe itself out. This one began, as we warned, it would be an arm wrestling match. And sure enough, there have been teasing rallies all along the way last year. Oh, this is the bottom. Oh, this is the bottom. There's still the word bottom comes up in conversations on financial TV. And that word doesn't come up anymore, then maybe you're near something, okay? Most bear markets in US stocks go down for a couple of years. Now, the 29 lasted from 29 to 32, so we're talking 2.5 years. But it never came back to its highs again until 1953. So people who expect the next bear market to be the launch of another great big bull, think twice. This is a massive change in asset pricing. And one thing we pointed out all during last year as we progressed month by month is that as the money flow started to slow into the stock market and seek other places to be, and it wasn't T-bonds. Quite often, T-bonds are an alternative for stocks. There's a 60-40 rule. If you've got 60% in stocks, 40% in bonds, you got a balanced portfolio. Well, whoever had that portfolio last year got killed worse in the bonds than they did in the stocks. So bonds were not a safe haven. So they got wiped out on both sides of the equation. But net on balance, at the end of the year, as we expected, gold did what? It was unchanged on the year. Boy, most portfolio owners would love to have had gold all year and come out unchanged. Silver was up 3% on the year. Commodities, the Bloomberg Commodity Index, which is what the Fed is fighting, right? Inflation, okay, their version, which means commodities only, which is a narrow definition, a false definition too. It's up 13% on the year last year. So, hey, what they're doing isn't working, at least what they say it's going to do. And I think there's going to be an awareness going forward, probably in 2023, among academicians and economists that, hey, you know what? This isn't working. We've had 100 years of the Fed, and we've had nothing but boom bust cycles. And they always seem to be causing it and then breaking it, causing it, then breaking it, It wouldn't shock me that in a couple of years, you don't have a Federal Reserve. It's not always been there, remember. It's been around 100 years. And mostly its effects have been felt in the last 50 years. So it's not like an institution forever. It could easily go by the wayside, and I suspect it might. But there's another variable out there that nobody's talking about when they talk about the markets and what's coming ahead. Whenever you get a huge market decline and asset decline that hurts people, I don't mean the 1%ers, but I mean the average guy in the street. And Amazon just laid off 18,000 people today. They could talk all they want to, the Fed, about how the tight job market, or they look at it, waiters and people carry bags in hotels or something. But in terms of major jobs, the opposite is occurring. All major companies are cutting. That's going to show up sooner or later in that metric that the Fed likes to point to, unemployment. But it'll be a lagged indicator. But whenever a market breaks hard, like it did in 2008 and 9, it has real world implications, not just stock market implications. This one's going to have far worse impact because of the nature of the bubble, the height it reached, and the unwinding that occurs. We also think that the one variable, and Nouriel Roubini, again, he's a Democrat, but he's come down real hard on what the Fed's done, thinks it's going to be a disaster. He even mentioned social disorder. And I think he's dead right on that. Like we've been mentioning that already. We don't think the political horizon is going to settle at all. And if you simply think about it, and I'm going to be neutral here, I'm not going to say who I'm for or against, because frankly, none. I'm a libertarian, okay? Mm-hmm. But Trump took over the GOP and fragmented it. We all know that. We know he has a hardcore base, a lot of which is new Republicans, in fact, people that never were before. His base is probably, I'm going to guess, 25, maybe even 30% of the GOP, hardcore base. They'll follow him anywhere, okay? And the rest of the party has now gotten skeptical of Trump. They sort of want to distance themselves without, pushing him away. They want to quietly drift away from him because they almost got beaten in the congressional election, which they thought they were going to have a major wave of that, and they didn't. They barely won. And that was probably because of the Trumpers running. Anyway, that party is split now. Okay. How can it reheal? Think about it now. Trump either one gets the nomination, which is highly questionable, given the fragmentation in the party and the people that are adamantly against giving it to him again. If he gets the nomination and runs, there'll be a piece of the GOP that's been there since Barry Goldwater's days, conservative, Reagan type, Barry Goldwater type, who aren't Trumpers. They're not going to vote for him. So when you come to the next national election, 2024, next congressional election, if he's running, he won't win. He doesn't have the GOP behind him. He'll have a hard core and they'll show up, but he doesn't have that fragment, the non-Trump piece, and he's not going to get it back. Okay, the other way, flip it over. He doesn't win the nomination, and he perceives that soon, sometime in the next month or 2 or 3. He realizes, hey, you know what? The Republican Party doesn't like me anymore. I'm going to create a third party. Okay, and he's going to run as a third party candidate. And why would he do that? Because you can bet that Trump is not going to retire to Mar-a-Lago and look at his portrait on the wall and say goodbye to his history. He's going to keep going because he views himself as an historical figure. So if they don't nominate him in the GOP, he's going to go independent, and he'll have a third party which will destroy the potential for the GOP to win the next election, because he'll take his hardcore block, call it 25, 30%, and remove it from the GOP. There's no way mathematically GOP could win. So either way, the GOP can't win the next election that I can see. And so anybody who thinks that, well, we're going to have this back and forth. No, you're not, because the party that was the alternative, let's say, is no longer a party. It's a broken party, and it can't reheal quickly because the Trumpers are going to go with Trump, and he's not going to quit. So put that into your mix of fundamentals. What does that mean if the politics can't heal? What does it mean if Trump runs either as GOP or as an independent and loses? What do you think his voters will do? Do you think they're going to quietly say, oh, okay, well, the Dems won, fine, okay, good. Or are they going to do something else? And I won't tell you what the something else is, but you can imagine. They're going to be plenty mad. The term secession will likely come up. Already, Ted Cruz in Texas, so about 9 months ago, mentioned the word. And he chuckled and said, no, it could be serious. It could be a serious term if we don't get our way ultimately. So anyway, that's a variable that should be factored into the markets, but is not being discussed. And I think it could happen quickly. In other words, you don't have to wait to 2024 to realize those variables I talked about. And that will impact sentiment, perception of what's coming, and enhance the bear market bubble breakage that we're seeing. Meanwhile, where do you go? We think it's gold and silver. We think that's why gold shrugged off. It had been up about 10, 12% on the year early, then went down to about 10, 12% in the summer. And it came back all the way to unchanged despite the downturn in other asset categories. Why did it do that? And I think if you read between the lines and sometimes on the lines of some of these major asset managers, you'll know why. That's an asset category that they're starting to favor, including the gold and silver miners. We think that will be the stellar standout category for people to survive, to maintain the value of their money units, save their savings, and so forth. The stock market will continue to be a loser, a major loser. So anyway, that's my broad view. And it's 2023 will be, I think, an historic year in terms of the things I talked about becoming reality and people becoming aware of those other variables.
So much to unpack. And Michael, that's actually why I want to bring you on the show. Is I find you have such a deep knowledge of what's going on in terms of the biases that a lot of people are not seeing in the finance sector, especially right now with all the things that you brought up on a political level and what the Fed is doing and not what they're saying, which I think is a key thing that a lot of investors or people need to pay attention to. And I really appreciate you sharing, a little bit of background of kind of what you do, where you currently stand right now, how you are positioned. It obviously sounds like at the end there that you're heavily positioned for gold and silver to protect your wealth and also take this as an opportunity. But something that I did want to just go back into is I know earlier in your career, you actually didn't know a lot about the markets or even technical analysts. There was an opportunity that you had. You met someone, which was David Johnston. I talked about him earlier on in your intro, and he was the chairman of the COMEX, which you spoke a little bit about it. Are there any memorable highlights or stories that you want to share with our listeners from that time?
Well, I would never went into the pits because I wasn't a pit broker, but Hutton's headquarters was in Battery Park on Broad Street, block or two from the New York Stock Exchange, where the COMEX was at that time. It was in its own building. It's an old classical building. And you could go into the pits there. This is 1975, 76. I was in New York. And it's neat because you don't see this anymore. In fact, everything's electronic now. But there were guys on scaffolding around the exterior walls of the building getting hand signals from floor brokers in the pits saying what quantity and what price was just traded. These guys with chalk would mark the price on the chalkboards around the interior of the building. The last price of the Fed gold, okay, and how many contracts were traded by hand with chalk. It was really fun. And I used to watch the pit brokers. Some of them were locals, what called locals. So local is a guy who owns his seat, but he does it for his own purpose. He trades his own account. He's not there to execute orders for a firm, and so forth. And so they're like vultures, and they're in the pit, and sometimes they see things. They keep little handmade charts in their pockets. I used to see them pull them out, do point and figure charts. And they would see a setup on a price chart where a certain market dips to a certain level and then rallies, dips to the same level, rally, dips to the same level, rally. All of a sudden, sell stop orders start to build up under that market. People say, gee, I don't want to break through that low we just made, okay? And those sell stop orders build up, maybe a couple hundred of them, and the floor broker smells blood, okay? So what he does is he goes in and he dumps some gold or silver, what he was trading, enough to break through that support level. So to run the stops. When you run the stops, you get all the selling and therefore a flush. Okay. So he sells, causes the break, assuming he causes the break. Maybe he doesn't, maybe it supports again. But if he breaks it, you get this flush and he scalps it. Scalps a certain number of dollars out of gold. He buys back his short, smiles. Meanwhile, everybody else is screaming and got stopped out and made losses, and he made money running their stops. Well, I learned from that quite often price charts build levels that any idiot could see looking at a price chart. You don't even have to be a technician. Where market goes to a certain level, bounces, same level over and over and over. And oh, golly, that's where it has to hold, right? If you believe in price charts. And so almost invariably, whenever a price chart sets up that kind of structure, be careful. Make sure that momentum agrees with it, because quite often you'll get one of these structures where price breaks out and you look over at the momentum chart, it didn't break out. So you get a non-confirmation. We look for those a lot as well in our work, to where we will trust price if momentum agrees with it. But if momentum doesn't agree, then we think it's a trap. And sometimes those traps can be pretty bloody, and we call them bear traps or bull traps. And we think, for instance, silver and gold just pulled off a bear trap. Now, example, gold. After going to 2070 in the year 2020, in the summer, it dropped back into a low in March of 2021 at 1670s. Okay. Went all the way back up, came back down in August. No, it didn't, not all the way back. Excuse me. It bounced from the March low in 2021, rallied, came back in August of 2021, again held around 1670. Oh boy, went up then. And in March of this past year, it got all the way back up to the highs again, 2070. Then it came down this summer, stopped in front of that 1670 yet again, a third time. So that, the price charts were saying, oh boy, it's holding. Okay. So then gold had a little bounce, and then it blew that out and dropped to 1617. So they ran all the stops. Everybody said, oh my gosh, gold is over. It's no good, no good. I heard that from everybody. And we said, no, it's a bear trap. And sure enough, next thing you know, now we're trading 1830, 1840. So that was a bear trap, where something bleeding obvious broke, and yet it was a joke. It was a fake out. These things happen a lot when you look at price charts. So anyway, that's one of the benefits of looking at momentum. Anyway, sorry to get off track there.
I actually appreciate you for sharing that, because I actually want to gently touch in terms of getting a better understanding of, your technical analyst and how you use that to keep your emotions out of play. So a question I have is, what is your momentum-based method of technical analyst, and how can it help investors determine the future market direction?
Well, when you look at a momentum chart, you're looking for the same things you do when you look at a price chart. You're looking for trends. Where a market zigzags up in a draw, you can draw a line under the lows and it's going up and so forth. Well, you look for the same thing on momentum, or maybe it's a floor, like I described, a flat floor or a flat ceiling, whatever. And when those things break out, it depends on the time scale. In other words, if you break out on some short-term metric, like some momentum breaks out over a 3-week average oscillator or something, well, that might be a trade, but it doesn't necessarily mean it's a big move, because you're measuring with a little microscope, daily action, weekly action, that kind of thing. When we measured for a top in the S&P and the NASDAQ, we were looking at annual momentum. We're measuring monthly bars in their relationship to a 36-month average or a 3-year average. So we're looking at big picture stuff. And so when we make a call on a market of significance, it's almost always based on something very long-term, rather than something short-term. A lot of people are very influenced by the zigs and zags we get every other week in this or that market. I mean, you could look at the stock market and think, well, this is a bull market again. This is a bull market again. And yet it's doing this, So you have to be careful about those little short-term and intermediate-term zigzags. You have to put them in context. And most investors, supposedly, although they do complain about short-term stuff, need to really be focused on what's going to happen over the next several quarters, several years, not what's going to happen in the next 2 weeks. And that's our prime focus. And that's why we're major bearish on the stock market. It's not because it broke some little thing in January or February. It broke something massive. In fact, if you saw some of our momentum charts, you would say, good grief, that's what momentum looks like. And it's only just begun. Because when you look at these long-term momentum charts, like Apple, Amazon, so forth, what they broke is like something so huge. It goes back 10 years, a structure. And it isn't even oversold. In other words, you're not even at levels on the momentum chart that say, hey, I'm oversold. No, you're not even close. So it's severely broken on a big time scale. And we think the consequences, therefore, will be in the real world, not just in the day-to-day action of the stock market.
Thanks for explaining that. I really appreciate it, because, I'm an investor first. I'm not a trader. I don't have that tool set or kind of background, which is why I follow people like you, as well as Christopher Mullen, as well as Tavi Costa, people that understand the technical sides, of what's actually happening in like the market. So I really appreciate all of your work. It really helps me stay emotionally in control and fit for my investment decisions. And it's not only myself that really values your work. Someone that I want to bring up, I told you this actually through an email, is Eric Sprott. He's a well-known Canadian billionaire in the sector. And in the yearly wrap-up, which was a couple weeks ago, just before Christmas, like it literally was a Christmas gift, he had high conviction about, precious metals going into 2023 and the strong move at the end of 2022. But the person he kept citing was you, Michael. Why do you think a very intelligent investor like Eric Sprott values your work so much?
Well, I can't speak for him. I thank him for his comments, obviously. Eric is more or less the king of silver right now. If you watch CNBC, the ticker tape go by, you'll see Sprott Gold Fund, Sprott Silver Trust, and so forth go by. They're great vehicles for owning bullion and so forth. And he's got one on uranium even. If silver does what I think it's going to do, which is meteoric on a percentage basis now, I think it'll vastly outpace gold. I mean, gold's the mama, but silver is like a wild child. When gold goes down, silver goes down more. When gold goes up, silver goes up more. And from what our analysis of silver is right now in relationship to gold, just the relationship, is vastly undervalued. And it routinely, over the last 50 years, silver will go up to a certain percent of the price of gold before it even runs into trouble in terms of its relative performance. We're not anywhere near that. In fact, if gold goes where I think it could go, which is to say replicate its prior 3 bull markets the last 50 years, each of which were either a 7-fold advance or an 8-fold advance. They were of different duration, but the 1970 to 1975, 1976 to 1980, 2000 to 2011, there were 7-fold or 8-fold advances from the low. And we didn't even have the kind of world we're in right now in terms of crisis. Gold has only doubled so far. Its bare low was in 2015 at 1,050. We got up to 2,070. A doubling, that's all. If gold simply replicated what it had done 3 times before, like almost a heartbeat, it'd be $8,000 gold. And that wouldn't even be outlandish because that would just simply be a replication of the percent gains it saw 3 times before. Well, if silver goes up to like a routine level for it in relation to gold, which is well over 2%. Right now, it's 1.3 something percent of gold. The price of gold, silver expresses the percent of the price of gold. If it went up to 2 point something percent and gold were at 8,000, you do the math. $160 an ounce for silver. Whoa, trading 23, 24 right now. These aren't outlandish assumptions, especially when you put it in context of what's going on out there in the other markets. And once the central banks of the world, especially the Fed, realize that they've busted the bubble, I don't think they're aware of that yet. And they see the real world implications. All of a sudden, the unemployment does get bad, suddenly, shockingly, not really. And other factors that they like to look at. They're going to have to reverse and go back to what they normally do, which is to say, print, money's free. Why? One of the primary roles is to support the government bond market, the most liquid market in the world, the US government bond market. Secretary of Treasury Yellen, about 2-3 months ago, said she was very concerned about the lack of liquidity, the growing illiquidity in the US government debt market. Whoa, that's a kind of statement you don't make unless it's true. So she was very honest in her confession there. The bond market went down more last year, US T-bonds, on a percent basis than did the S&P. Even went down more than the NASDAQ 100 on a percent basis. So it was a disaster, but it also became illiquid, meaning the day-to-day liquidity and stability of the pricing mechanism in the bond market became questionable to her. Well, that's the most dangerous word you can use in markets is liquidity. That's what happened to mortgage-backed securities. Once they became illiquid, poof, market collapsed. Go see the movie Trading Places, and then go see the other one, Margin Call, that dealt with the mortgage-backed security crisis. Quite a good movie, Margin Call. It's very realistic. But when she admits that, and you're dealing with the biggest market in the world, the most liquid, the most important, the central bank can't ignore it and say, oh, well, we're bringing down inflation. Yeah, right, you're collapsing the bond market. They're going to have to reverse. Now, at that point, of course, they'll lose credibility. That's fine. Maybe they should. But that's a variable that's out there that even Yellen admitted was a variable that concerned her. You cannot have an illiquid government bond market. That changes everything. And once they do that, what does that mean for gold and silver? It means, once again, they're going back on a monetary policy to print, do whatever they have to do in the balance sheet, et cetera, to support the government debt market and other municipal bonds as well, high yield corporate debt, which are markets they literally bought into in 2020, by the way, the Fed did. So they don't just buy US government bonds, they buy the other stuff too if it needs help, and they will need help. So anyway, that's a variable there that could drive silver and gold off the page in terms of present valuations, and particularly move that silver gold ratio back to more normal levels. So anyway, that's where our primary focus is. We also think the commodities will have another leg up. They're having a correction now. They've had a correction now for 6-7 months, actually. It's been sort of an arm wrestling thing, and it flattened out. It isn't really dropping much. Even by the end of the year, it's still up 13%, Bloomberg Commodity Index, despite the correction. We think there'll be another wave up in commodities, probably with the emphasis. Leadership last time was energy. This time, probably food. Things we don't think about, like sugar. So flip a package over at the grocery store, somewhere down there it says sugar. Okay. Anyway, that will also go to the upside one more time, maybe a couple more times. But our focus is on gold and silver. We think they'll be the leaders because we think we have a pending monetary crisis where the central banks have created a situation that they have to panic their way out of.
Thanks, Michael, for giving all those details, in terms of your whys behind why you're currently positioned, on the gold and silver end. And it makes sense why, someone like Eric Sprott, values like the work that you do. But something that I actually want to tie in here is, it's pretty obvious from this conversation that you're bullish on gold and silver. And I know you actually have strong conviction that silver will most likely outperform over the next couple of years gold. Something that I want to share, because you mentioned that, it's consolidated lately, or it's starting to do that right now. And there's some history I want to share with silver's performance, and I want to get your comments on. And what I want to bring up is in 2005, silver consolidated for 595 days, and then it broke out to a new high and ran 127% in 36 weeks. In 2007, silver consolidated for 539 days and then ran 93% in 31 weeks. Then in 2010, silver consolidated for 770 days when it broke out to new high and ran 161% in 35 weeks. Now, currently today, as we speak, silver has now consolidated for 879 days. So my question to you is, where do you see silver going next in terms of how much percentage wise? And how can an investor listening to this show position themselves properly to take advantage of this next once in a lifetime opportunity?
But we don't recommend specific investments. I mean, in our disclaimer at the end of each report, we state whether we have a position, okay? Yep. But it's not necessarily valid for each investor. There's all kinds of vehicles. You can own outright bullion coins. You can own ETFs that are bullion reflective. Sprott Silver Trust, for example. SLV is another bullion ETF, futures-based bullion ETF. Those are vehicles you don't have to use leverage on. And after all, if you're talking about a move in silver that goes from the 20s to, well over 100 or maybe 200, you're talking a huge percent gain anyway. You almost don't even need leverage for a huge gain. Other folks are used to options. We suggest long-dated options, go out a year or a year and a half, that kind of thing. Don't buy something that's going to expire 3 months from now. That's another way to do it. Some people use futures, which allow you to use some leverage there. It depends on the investor. What's his capabilities, what are his risks, so forth. What's his horizon? So we can't talk about that. Silver miners is a good place to be. I think they're vastly underdone, oversold, and vastly cheap in relation to silver. And quite often investors and asset managers won't go in and buy the metal itself. They'll go for the miners, the stocks. And so, you'll see a lot of the big funds, that's where they're going to go. So if gold and silver re-engage in a way that people say, oh my gosh, they're re-engaged to the upside. The big fund managers in chasing that probably won't buy the bullion, they'll probably buy the miners. And the miners do the same as silver. They tend to underperform when gold is pulling back, they go down more. When gold going up, they go up more. And I think that'll be the case this time around. The miners will beat gold, silver will beat gold. But watch gold. Gold's the mama. Okay. Anyway, so that's an answer to your question. I don't know. It depends on the investor, what the medium is, what the leverage is, time frame, and so forth. There's plenty of options out there for that, choices.
Awesome. Yeah, no, I appreciate that honest answer. And thanks for giving different options of kind of where they could go. Michael, for the benefit of my listeners, what are some of the most influential books that you have read over your life that you think hold great value for investors?
Guy I knew at E.F. Hutton back in 1976 was their plywood specialist. It was a plywood futures contract. Name was Arthur Sklarou, Sklarew. I don't think he's around anymore. He may be. I hope he is, but I don't think he is. He wrote a book called Techniques of a Professional Commodity Chart Analyst. It's a little known technical book. It's primarily price chart based, but he does have a chapter on momentum. And he does some things I kind of like. That he somewhat dismisses Elliott wave, for example, which he thinks was sort of overdone. But it's a good technical analysis book. It's not real big. It's not way over your head. It's good. Techniques of a Professional Commodity Chart Analyst. And you can go to Amazon and find it. That's probably my favorite technical book. I've read a lot of others, but that's my favorite. And I don't intend to write one. And most people who deal with momentum deal with it on the level that you can get for free on your quote screen, the MACD, moving average, convergence, divergence, and RSI, relative strength index. But those indicators don't tend to develop structure like what we do when we plot momentum. You could see it's like a price chart, rigid structures, horizontal lines, uptrend lines. Those tend to be like wet noodles. They literally are. So they either turn down, they turn up, that kind of thing. So they're not real snappy, accurate. They're more lazy indicators. So I'm not much into what's commonly called momentum analysis today. We have our own brand. Anyway, but Techniques of a Professional Commodity Chart Analyst. There we go.
Awesome, Michael. Thank you. Yeah. And they always say less is more. So I appreciate that you shared that one impactful book. And Michael, you've worked with a lot of high profile investors, as well as traders, as well as institutions. But what do you believe separates a good investor from a great investor?
The longer duration view and positioning accordingly. Some traders, or some people are traders, they like that. They like getting in and being out 2 weeks later. They feel more comfortable doing that. That's fine. And we do, to some extent, cater to that. We do have sometimes short-term analysis where we will identify a downturn in the S&P, for instance, recently twice a month ago or so went up to 4,100, backed off a bit, and went back to 4,100, like, well, I'm going to break out. Okay. As soon as it rolled over from that 4,100 the second time, our momentum said, sell it, it's going back down. And sure enough, we went down to 3,700 or so pretty quickly. That was a short-term signal. It was within the context of the bigger bearish view we have, but it was in and of itself just a short-term little metric. So it created a nice short-term trade. But ultimately, when you do that, you really got to be intense. In other words, you have to be focused day to day, week to week. Whereas a long-term investor looking at larger metrics, once the trend turns up on a long-term metric, it doesn't generally turn back down again anytime soon. Probably talking a year or two out, maybe even more. And similarly with the S&P top we recently made, the stock market top, I think, expect at least a couple of years. We've only had 9-10 months of downside since our sell signal. So it's fresh, it's got plenty of room to go, and it's going to do it. But have a longer term view. And when you do that, it means you can't be ticker taped to the market. If you are, you get scared every other day. Market's rallying. Oh my gosh, I'm wrong. That kind of thing. You got to have know what context you're in, live in that context, and position accordingly. So if you got a highly leveraged, time-sensitive thing like a call option that's going to expire in a month, well, yeah, you got to be concerned about the short term. But if you're long-term, bearish, long-term bullish, you don't have a vehicle that's appropriate for that.
Those were a lot of really good points that I think, honestly, secret ingredients, or maybe not so secret, but I appreciate you for sharing those. How could someone stay, emotionally in control of their emotions when going through all those highs and lows in the market?
Having confidence in whatever metric you're using. In other words, if something told you to be bearish or bullish, then focus on that and know when to blank out the noise, because otherwise you'll get whipsawed a dozen times and you'll never catch the major move. And that's usually what happens to most investors. They never catch the major move because they get whipsawed by some false bottom, some false top in a bull trend, etc. And if you go in with a certain metric, stick with that metric until that metric says, okay, it's over. Unless you want to have two portfolios, one's intermediate term, one's long term, that's fine too. But know the context you're in. That's all.
So know your investment and stick to your high conviction. That's like the summary I got.
Yeah, and make sure you've got a tool that you can have high convictions about. you know.
And if you don't have the tool, maybe follow an expert like yourself.
Well, that's, it's called division of labor.
Yeah.
I'm an expert in certain things. Other people are experts in other things. So, and that's why I hire people to do things like, put wiring in my new house and that kind of thing. I don't do that. Anyway, it's called division of labor, and it's the way the world works.
Absolutely. And Michael, the purpose of this podcast is to inspire millions of people to achieve greatness and enhance their overall personal well-being. So what is your definition of greatness?
Just about what you said. Find something you do well that perhaps is somewhat unique to everybody around you, and pursue it. And pursue it to the point where you become so good at it that you're great at it. And that's often how, innovators break through and go from poverty to wealth or whatever. And also feel good about themselves because they know they're doing good stuff, and it helps them and it helps their customers. So, that's the main thing, is to get some degree of perfection in an area that you're good at. It doesn't have to be everything. Nobody can be everything. So whatever you do well, do it really well.
That's a beautiful definition. I definitely agree that people can be good at a lot of things, but it's better to focus on maybe less than 3 things and really embrace like the passion and all that stuff for it. So I appreciate that. Michael, now that you have, a good feel of what my podcast is about, who is a future guest, someone that you know personally that you would like to see on the show?
Sprott would be a good one. Can always have my son on, Brett, sometime. He helps run this operation. Most of the people I'd like you to interview, unfortunately, are past. Ayn Rand, Murray Rothbard. I think they're great figures and will be seen as such over time. But no, nobody in particular. I don't endorse necessarily other analysts because my methodology is mine, it's ours, and they have their method, and that's fine. Good. They're good at their fundamental analysis or even their price charts, whatever. So, there's a lot of good folks out there to interview in the market arena. And you've probably interviewed some of them. I think Rick Rule has been on your show, so forth. Anyway, that's my best thought.
Okay, so Eric Sprott, that's a big name to get. I'll do my best, and when that moment happens, I'll be sure to send him your way. So you could tune in. I want to take this last moment here, Michael, for you to promote yourself. Where is the best place, for my listeners to connect with you or follow your work online?
Well, we do have a Twitter page, but my son handles that. It's, MSA. I don't know the Twitter title. I didn't even go to the page. But our website is Oliver MSA for Momentum Structural, and MSA.com. There's a lot of information there. And we even have some old sample reports you can click on, and you can always request current samples. So go there and send me an email. Under my beautiful picture, there's my email address. Click on it and send me an email, ask for some current reports, and I'll send you a sampling of some of our reports. That cover all different kind of markets, not just gold and silver. And there's an explanation of our methodology on the site in some depth, including a video that goes back to 1995, showing our calls on the stock market, highs and lows, up through about, I think, 2015. We haven't updated it. So there's a lot of information there you can get just by clicking on that site and taking a tour. Anyway, that's my suggestion.
Awesome, Michael. Well, I will be sure, to put all that information in the podcast notes. That way all my listeners know where to click and also know where to go. And I want to take this last moment to really, thank you for your time. Thank you for sharing your expertise, your knowledge, your wisdom, your insights. I'm sure it's going to, add a lot of value to people that are tuning in. And I just want to end off by, just thanking you for being here today.
Well, thank you very much, man. I appreciate it. Hope I offered some good ideas.
Thank you for listening to the Living Your Greatness podcast. If this show has added some value, don't be shy to subscribe, leave a rating, and make a review.